So here's an odd thing about turning 40 that I've noticed with the people that I work with often. I mean, Jesus, I'm not a million miles away myself. You are almost certainly earning more money than you've ever earned in your life. And yet, there's a decent chance that you feel almost further behind than you did at 30. It's not a maths problem. It's not a money problem. It's a habit problem. And I've worked with enough 40-year-olds now to tell you the gap between the ones who are fine on their way to building the wealth they actually want and the ones who are quietly panicking genuinely has nothing to do with like the salary on their payslip. It is honestly 5 key habits. That's genuinely it. And the 5th one, by the way, is the one that changes all the other 4. So stay with me on that one. Okay, so habit number 1. You have got to start taking your own hands off the wheel. Look, think about why your mortgage gets paid every single month without fail, or at least I hope it does. Even in the months where money's a bit tight and like maybe Christmas has pulled your pants down, right? It's not discipline. You didn't sit down on the first of the month and heroically decide to honor your commitments. It just gets taken, right? Nobody asks you to theoretically pay your mortgage every single month. It just gets taken. Now, think about how much you saved last month. That one required you to decide, didn't it, at the end of the month with whatever was left over, whilst also starting to feel a bit skint. And that is exactly why it didn't happen. So the habit is simple. Every pound you intend to save or invest leaves your account on or after payday automatically, before your brain gets to like vote or have a chance to sabotage you. Standing order out to your savings, direct debit into your investment account, pension going straight off of your payslip. Then, and this is the bit that people genuinely skip, whatever's left is yours to spend, right? Whatever's left over after that automation, that's your spending money. No guilt attached, right? You've already done the important part on the 26th of the month when it landed. So the coffee and the little luxuries on the 14th of the month, the next month, don't really matter. That's the whole point here. Automation isn't there to make you good with money. It's there to make it so that you don't have to be, right? Super important. Number 2, you have to get your feelings out of the room. Let me explain. So March 2020, right? We all know what was happening then. So I was on the phone with someone who had spent at that point about 11 years building up an investment account that he was really, really super proud of. And he'd watched about 1/3 of it evaporate in 3 weeks when the markets dropped. And he literally kept saying the same sentence to me over and over again. He was like, I just want it to stop. I just want it sold. I know what you're saying, Josh, but I'm not interested in any of this. And he moved everything to cash despite me absolutely pleading with him. And guess what? He felt an enormous relief for like 3 days. And then he had to watch the whole thing recover without him. Absolutely classic. That decision cost him way more than any fee or any fund choice or any bit of clever tax planning ever would have. And this guy, he wasn't an idiot, right? He was actually a really smart bloke who really understood this whole thing. He was just a guy who made a decision while he was frightened. It can happen to any one of us. And here's the strange part that truly a lot of people don't actually think about. There's a lot of misconception between basically a house and a pension or an investment, right? You already own an asset that fluctuates in value, and you do not panic because nobody tells you the price every single day. It's your house, right? It's your property. That fluctuates in value all the time and you just don't see it. Look, if your phone pinged you every single morning with your house is now worth £11,000 more than it was yesterday, at a certain point, you would have sold. Like in 2008 with the crisis, you would have sold And that would have been the wrong and a disastrous decision. So the method is boring, but it works. You write down your rules, what you're wanting to achieve, what you're looking to do while you're calm. And guess what? You follow them when you're not calm. So figure out what to invest in, how much goes in each month, and what you'll do in a crash, which should be nothing, okay? And then here's the critical point. Stop looking. Just stop looking. Check quarterly at most. And if it's still too tempting, just get rid of your logins and check once a year, okay? I think a lot of people are far too obsessed with checking their investment account like it's some sort of game or some sort of gambling game on their phone. Just set it up, invest in something that has positive expectancy, that's aligned to your risk profile and your time horizon, and just forget it, okay? Don't give yourself the stress. Have additional stress elsewhere in your job and trying to earn more money, not in your investments. Number 3, start tracking the right number, the number that's actually measuring your progression, okay? Look, I would say that I spent most of my 20s being obsessed and kind of tracking my income, right? Pay rise, feel great. Bonus, feel great. I could have told you my salary to the pound at any one given moment and what I'd expect to earn over the next 3 to 5 years. But if you'd have asked me in the same breath what I was actually worth, what my wealth building had actually achieved, I would have absolutely no idea, right? And the honest answer for a few of those years was probably a lot less than I wanted it to be, right? So that will give you everything you need to know. Net worth, of course, is just everything you own, assets, minus everything that you owe, liabilities. That's all it is. So house, pensions, investments, savings, the cash in your current account, minus mortgage, loans, credit cards, things that you forget about, car finance, for instance, the things that you put to the back of your mind is all on there. And look, the reason this matters completely, and I think this is such an important principle to get your head around, is that your income, right, tells you how fast you're going. And your net worth tells you how far you've actually traveled. Look, you can drive around at 90 miles an hour, right, around a roundabout, for instance, for 6 hours, right? Brilliant speed. You're going super fast, but you're not going anywhere, right? So that's a really key criteria to keep in mind. Income is speed, net worth is distance. It is a really, really important framing in terms of what you're doing. So look, the method here is simple. Just get a really basic spreadsheet. 1 row per month, same day every month, assets in one column, debts in another, difference at the end, your net worth. Super simple, 10 minutes. And the first time you do it, it will probably be slightly uncomfortable. I'm not going to lie to you, which is exactly why this whole thing is worth doing. Because from that day, you're steering by the right number effectively. The pay rises that you get stop feeling like progress unless they actually start showing up in that net worth figure. Super, super important. Number 4, absolutely critical habit to try to start getting into. Close the gap as much as humanly possible between what you earn and what you keep. Absolutely critical. So there was a bloke that I worked with once he was on this absolute mission, right? He'd spent about 6 months campaigning and structuring and rolling out this case for a pay rise, right? Again, genuinely, he built the case. He did his research on what he could get elsewhere, and they had all the awkward meetings and chased the whole thing through 2 reschedules. Anyway, finally got this pay rise, $5,000, right? Which to him at that moment in time was a lot of money. He was absolutely delighted. And then I remember him telling me that the pay slip where the pay rise first happened came through, and it was about 240 quid's difference. Because, here's the key point, he was a higher rate taxpayer, and roughly 42 pence in every single pound went straight back out again in income tax and national insurance, right? Crazy. So we sat down and did another version of this whole thing. If he'd sacrificed £5,000 into his pension instead, So salary sacrifice, which is just where you agree to take slightly less pay in your pocket and your employer pays that straight into a pension for you without tax. His take home, yes, it would have dropped by that £240 a month figure. That definitely would have been there. It's called salary sacrifice, right? Same money out of his pocket to the absolute penny, but £5,000 landed into his pension rather than 2,900 landing into his current account. So the 240 quid a month out of his pocket. 6 months of emotional fighting and everything that he went through to get £2,900. When the £5,000 was kind of sitting there the whole time, right? It was crazy what he chose to do with that. Now that is such a phenomenally powerful lever in your 40s. Every £100 that you put into a pension as a higher or additional rate taxpayer, well, higher rate taxpayer costs you £60 of actual take-home pay because you're paying it out of money that hasn't been taxed yet. You're not being like clever or sophisticated. You're not doing anything exotic. You're just choosing which side of that tax line that your money currently sits on and how you build wealth with it. And it gets even sharper and even more attractive if you're anywhere near the £100,000. Between 100,000 and about 125,000, your tax-free personal allowance gets taken away bit by bit the more you earn. So that's that bit that you pay 0% tax on in that first bit of your income. And the effective tax rate on that slice of income is around 60%. 60 pence in every pound you earn. Now, pension contributions are what we call a income reducer, taxable income reducer, right? And it brings your adjusted net income back down below that 100k line. It is the closest thing to free money that exists in personal finance, truly. And most people earning that sort of money have never had anyone explain this whole thing to them. It is crazy. So if you're earning 110,000, you put 10,000 into a pension, you get all of that personal allowance back and avoid that 60% tax trap. It is just a complete no-brainer at this level here, okay? Like, genuine no-brainer. Now, the absolute valid objection, I can't touch it for ages. I know. And that's the reason most people in their 20s talk themselves out of it. And honestly, I would say that's a fair objection at 25. But if you're watching this, you're probably not 25. Right now, you can get your pension at 55, and that is going up to 57 in 2028. And of course, when the time comes, 25% of that pension comes out completely tax-free. It's called your pension commencement lump sum, a PCLS. The rest is taxable at marginal rate, but we can be smart with how we take money out of a pension. You are closer to that day, if you're watching this, than you probably are to when your first ever payslip landed. It's not some abstract, distant thing that you're never going to see. It's like a length of a mortgage away, right? And you don't seem to think that your mortgage is theoretical. That's not looking at it in the same way, is it? So the methodology is simple. Get your payslip this week and find two numbers: your gross pay and what's currently going into your pension. Okay, really two critical numbers. Then find out whether your employer offers salary sacrifice or any employer matching or anything like that. Because if they do, you also dodge national insurance on that sum as well, and it costs you even less, and they put money in there for you as well. So then what you want to do, and this is a really sneaky tip that I've tried over the years with people, increase the contribution by just 1%, right? Just 1%. And then just live with that for a little bit, right? You will naturally adjust. You won't notice it. You won't feel it. Then do it again when you're ready or after the next pay rise or whatever it is. Just keep constantly increasing it ever so much that you don't notice it, right? That's how you take a pay rise and keep the whole thing rather than just being absolutely ravaged for at least half of it. Okay, and number 5. This is the one that makes the other 4 actually mean something. You can do everything we've talked about brilliantly and still feel like anxious, right? And I see this constantly in the one-to-one work that I do. People with genuinely healthy finances who are still sort of vaguely worried for no particular reason, but just feel worried about it because they're saving towards more. And more isn't a target, right? You can't hit more. And the reality is with more, you can't ever be finished. So you need an actual number and an actual date. Absolutely critical in your 40s. So start with the rough rule that financial planners use, right? The 4% rule. What the 4% rule says is that you can withdraw from a sensibly invested pot around 4% a year and reasonably expect that pot to last you for the rest of your life, right? A little bit more nuanced than that, but this is a really good starting point, which means you can flip that equation around, can't you? Whatever you need per year, multiply that by 25, and that is the pot that you need. That's the amount of money that you need to withdraw 4% a year from and give you the sustainable income that you need. So let's say 30 grand a year, that is £750,000 that you need. Now, that feels enormous written down like that, and you're probably panicking when you see that. But here's where it changes sort of shape slightly. Most people don't actually want full retirement at like 50, right? What they want is to stop being trapped by work optional. The point where your bills, your mortgage, your food, the basic running of your life is covered without you, with the possibility that passive income can cover those sorts of things. So that at that point, every hour you work after that point is a complete choice, right? And that number is often much, much smaller, genuinely. If your genuine baseline is, let's say, £1,800 a month, you are going to need £540,000, okay? And the reality is that you probably already have a chunk of that sitting in pensions that you half forgotten about from 3 years ago, okay? So the method is simple. Work out what your life actually costs at its floor, not necessarily what your dream retirement is or your dream, full retirement figure, but figure out what your monthly floor is. It's a really good habit to get into in your 40s. Multiply it by 12, multiply it by 25. Then subtract what you've already got. Don't forget this bit, right? Whatever's left is the only number that matters. And once you've got that number, every one of the 4 habits that we've talked about stops being a vague good idea, right? And turns into a plan, more importantly, a plan with a finish line to it. And for most 40-year-olds I've done this with, that line arrives years earlier than they had assumed. That's the whole truth with it, right? So the reality here is that when you boil it down, these habits are all part of an absolutely critical 10-year period that truly decides whether you retire rich or whether you have to work well into your 60s and 70s. Now, to understand what else you need to factor in this 10-year period, you should really watch this video here next, where I go through literally everything you need to know about that critical 10 years that decide how you actually retire. So look, give it a click and I'll see you